Hi, I'm Stacy Francis of Francis Financial, and I'm so happy that you are here today. We're going to be talking about 2022 and thankfully moving on to 2023. Each month, you are going to be getting copies of these investment insights, giving you updates about the market, what to expect, and how to plan, grow, and protect your wealth. But most importantly, if you have investments questions or just questions about your financial life, feel free to reach out. I will tell you personally, my favorite thing to do, the favorite part of my job is meeting with clients, meeting with individuals who maybe aren't clients, but just interested in learning more. It makes my heart full, it makes me warm, and I do want you to reach out. You can reach out to me at Stacy, Stacy, at Francis Financial, or you can go to our website and there is a wealth of information, hundreds of fantastic articles, many of them written by me and my colleagues on the team at www.francisfinancial.com. All right, so let's get started. Well, let's be honest. 2022, well, I would say the technical term, it sucked. And December was no different. It was a disappointing finish to what I think of is a phenomenally disappointing year. Well, what does this chart mean? Well, if you look at the left-hand side of the chart, you're going to see a lot of negatives. And what's really, really unbelievable is that every single asset class, even the diversified portfolio that you see here at the top, posted 1 year negative returns for 2022. Now, the positive is when we look at the 3-year annualized growth, nearly all those asset classes are in the positive. And the star performers over those 3 years, you can see, was the S&P 500, still posting a 7.5% return on average each year. Another star performer were large cap growth stocks that you can see posting about that same amount and just slightly less. Value stocks are still definitely in the green and having good returns over those long term periods. What is unique as you look to the left-hand side of the screen, you see what areas actually outperformed others. And one of those is international stocks. International stocks outperformed U.S. stocks in 2022 for the year after 4 years of what we've seen as relative underperformance. The other story here is that growth stocks, you can see growth stocks had a much, much tougher year, almost a 30% drop in value in 1 year. That is historic. And they've actually outperformed value stocks, which you can see had a much slighter return loss, just about a 7% loss. And value stocks outperformed growth stocks for the first time in 5 years. The other star performer, relative star performer compared to the other losses were small company stocks. And you can see small company stocks did better than large company stocks. Now let's talk about bonds. Bonds had the worst year in modern history, dating all the way back to 1976. And let me show you this chart. And I'm glad that you are sitting down. Typically, bonds are a buffer in a portfolio. And if you've ever heard me speak before, I call them the airbag to the portfolio, the seatbelt to a portfolio. Bonds are what you can really rely on in times of stress. That has been absolutely true. Looking at 2008 and 2009 here, you see that they were significant buffers, having returns of 5-6% in a time where we had one of our biggest, most significant recessions ever during the years, again, of 2008 and 2009. However, this was not the case last year. And why was it? Well, when the Federal Reserve raises interest rates, it means that all new bonds are issued at higher rates. And what does that mean for those current bonds in circulation? They're paying a lower interest rate versus the interest rate that you could get. So it had massive implications, and in particular had a significant drop in bond performance for 2022, and we could not use bonds as ballast for the portfolio. So we saw that the 60-40 portfolio, and when I say the 60-40 portfolio, 60% stocks, 40% bonds, had one of the worst performances since the Great Depression. And why was that? Well, I just talked about bonds being essentially decimated by these seven different Federal Reserve rate hikes. But businesses also felt the pressure. Inflation that you feel when you're going to the grocery store, eggs are now what, $4? Or the gas station. Businesses are also feeling that and having a harder time posting profits. In addition, wage growth has continued. Employees and are demanding higher wages, and they can because the current unemployment rates are at historic lows. So all of this creates what we call one of the biggest perfect storms you can imagine. And so according to T. Rowe Price, I was looking at this study that I thought was really interesting. They said that based on the normal risk-return relationship, since the advent of the modern bond market back in the 1970s, the extreme losses for a diversified portfolio, this probability happens only once in 130 years. So it was very atypical what we saw in 2020. And what I have to say, what we do want to look at is, what does this mean for your portfolio going forward? And this is especially important for individuals who are looking to potentially tap their portfolio as they retire in the next few years. It's also extremely important for those individuals that we are sending a paycheck from their portfolio every single month to cover living expenses. Well, I have to tell you, in the whole morass of depressing statistics and information, here is our highlight. So the silver lining to a tough year is that 2023 and future returns are expected to be much higher. And from this chart that you see here, they're actually expected to be much higher today than they were even just a year ago. Stock forecasts have moved up about 3% higher compared to 2022. And US bonds are expected to deliver an average 5% return each year over the next 10 to 15 years. So in other words, in the next 10 to 15 years, you are going to be looking at phenomenal returns, much higher than we had expected even 12 months ago. 12 months ago, you can see here that our return expectations for US large company stocks was a mere 4.1% each year over the next 10 to 15 years. Now, where we are today and where we sit, that number has almost doubled. You can see that our return expectations are almost an 8%, 7.9% return expected each year over these next 10 to 15 years. So the main point here is that after a extremely tough 2022, things look a lot more attractive. And going forward, returns are expected to be much higher, essentially because valuations have come down. So what are the things that we can do in down years, the things that we did for you? Well, number one, we were extremely busy with tax loss harvesting. And tax loss harvesting, it can be quite complicated. And just so you know, if you have any questions, you can go right on the YouTube and see that we have a few videos that we've created to really explain what this very sophisticated strategy is and why it's so important. And I'll cut to the chase. It can save you 10, 20, even hundreds of thousands of dollars in taxes. And we know that what really matters with returns is what goes in your pocket after Uncle Sam comes to knock on your door. We've also restructured our portfolios. and made sure that they are as tax efficient and low fee as possible for our clients, making them as streamlined, as efficient as a Lamborghini F1 race car. And as I mentioned, valuations over the next 12 months definitely look much more attractive. The potential for returns have actually really increased significantly. Bond yields are above 5%. Even money markets and some of those cash accounts are at 4%. So a lot of opportunity there. One of my favorite reporters for the Wall Street Journal, Jason, he is a fantastic and one of the most well-known and respected thought leaders. He talks about what is important to be a successful investor. And he shares here that it's actually not necessarily the smartest person in the room, but it's someone that has the most patience and also the most self-discipline. So successful investing requires strong character, including being able to weather the ups and the downs of the market, having sound judgment, and really true patience, and also self-discipline. Well, I feel like we needed that in spades last year, but we are being rewarded. In fact, just this month in January 2023, the S&P 500 had its best January in 4 years. In literally 1 month, S&P reversed significantly, posting a 7% return. And US aggregate bonds were no slouch either. They had a fantastic return of 3.25%. And these are phenomenally high numbers, especially for just a 4-week period. So know that we are always here for you. You never have to do this alone. As I mentioned, one of my favorite things to do is to talk to individuals and to talk about their portfolio, talk about their hopes, their dreams, and most importantly, make them into reality. So we are here to talk to you, creating that beautiful financial plan model out to the future, and then also constructing a portfolio that will ensure that all those hopes and dreams can come into reality. So we are there consistently rebalancing for you, looking at tax implications and reducing taxes for you. We also are phenomenally cheap. And when I say that, I mean cheap in a good way. We know that ETFs and mutual funds that have higher fees within them don't outperform. And so we are ruthless at bringing those fees down so that, again, the maximum amount of money goes into your pocket at the end of the year. We also look at the appropriate asset allocation between stocks and bonds and make sure that as your life changes, that stays also changes, making enhancements and tweaks along the way and helping you and holding your hand through very challenging market conditions. We are here for you, making sure that you understand where you are, what your portfolio is doing, and how it impacts your financial plan. If you have any questions about the material that I have shared here today, please do reach out. As I mentioned, you can reach me at Stacy, S-T-A-C-Y, at francisfinancial.com, as well as www.francisfinancial.com for hundreds of fantastic articles and resources of anything money you could imagine. Thank you again, Stacy Francis, President and CEO of Francis Financial, founder of Savvy Ladies. Thank you for joining us.